Well, good afternoon, everybody. Welcome to our lunch and learn session for this month. I've got a couple of sales ideas that I'd like to share with you. Uh, as I think of sales ideas, to me, in our profession, we have two kinds of sales. We have got those that put bread on the table, and then we have those that put money in the bank. And what your limit is for somebody that's going to, or something that's got money in the bank, I'm thinking commissions that are $10,000 or more on a sale. Whereas those ones that put bread on the table are those $200 and $300 commissions that we see on a regular basis, term cases, et cetera, small life policies, whatever. So the first idea I have is one that's more put bread on the table kind of an idea. Are you going to get rich doing this? Probably not. Is it something that's going to be, I think, an easy sale? Because I learned this. I just actually learned about this about 2 months ago from another producer that gave it to me. And I said, that's just a fantastic idea. And as many of you know, I don't have too many clients, but I did have one come in the day before yesterday, I think it was. And I gave him this idea, see what he thought about it. And he's going to do it for himself. So with that said, let's go ahead and talk about what it is. And you can see it from my screen here. And the idea is to approach grandparents, grandpa and grandma on this, to buy a small single premium immediate annuity for their grandchild that will pay an amount to the grandchild on every birthday as long as they live. So the grandchild now, every birthday, gets that gift from grandma and or grandpa every year as long as they live. Gives them a little token to remember them by as they go out and they get to 45, 50, 60. Grandma and grandpa are no longer here, but guess what? That check keeps rolling into them. And as you see, I did this for a $10,000 one-time premium. This one I showed the birth date was actually should have been January 1 was the birth date. The start date should have been January 1, 2027. It won't make that much difference. But for this 18-year-old male, that $10,000 single premium would generate $557 every year to that 18-year-old grandchild as long as they live. Something unfortunate to happen, it has a cash refund in here. So if the amount of payments didn't equal the principal, the premium payment, the balance would be refunded. But I did that for an 18-year-old. And Christy, okay, hold on. So let's look at a 12-year-old female. For a 12-year-old female, it's about the same. They get $548. So as long as that young lady is alive, grandma and grandpa are giving her $548 each year on her birthday. Now the numbers will be a little different for each age and the sex, but basically $10,000 is going to generate somewhere between $500 and $575 a year for that grandchild. I told you that I showed this to one of my clients this week, and he's going to do it for all 6 of his grandchildren. And I'm sitting there talking about leaving a legacy for grandma and grandpa for the grandchild. And the first thing he said is, I like this idea because now I don't have to worry about what to get them for their birthday. That was an interesting thought that I had not thought about. But now grandma and grandpa don't have to go shopping for the grandchild that lives 3 states away that they see 3 times a year and not sure what interest they have or don't have. So I thought that was also a very pertinent piece to this. But I think that this is a great sale for grandparents. So the question you have then is, well, maybe if I've got four grandchildren, I may not have $40,000 to put aside for them. So I've also done it for $5,000. Now, if you know this is a 12-year-old female, the amount goes down to $239 every year. So there's a better bang for your buck for $10,000 because if you drop down to five, a lot less companies participate. As you can see, look at all these companies say the premium specified is too low, too low, too low. There's probably 12 or 15 companies that don't want to participate down at $5,000. But you can do that. Okay. The male, if you do the 5,000 for the male, it's going to be around a 240 or 250 amount. If they want to round it off and make it 250, it's probably $5,216 a premium or something such as that. Now, as I said, this is not something that's going to make you rich. But if you're selling 3 or 4 of these to a grandparent and you do one a month, that's going to have probably a $1,000, $1,200, $1,500 a month commission to you, because the commission on most of the SPIAs are around 3%. Some a little bit more, but mostly around 3%. So this is an idea, and I will just tell you that I stole this from somebody else that gave it to me about 2 months ago. I'll stop here. Does anybody have any questions or want to talk about that? Nothing? Okay. Now we're going to move on to.
Well, no, Ralph, I was going to say, what about the surrender terms?
Yeah, most of these will have a commutation value. It's really not a surrender value in immediate annuities. It's called a commutation value.
Okay.
And there would be some amount to that. And I would suggest that we find a company where the owner of the annuity can be the grandparent. So some companies will allow a different owner than the annuitant. Some will not allow or force the owner to be the annuitant.
Oh, interesting. Okay, thank you.
Yeah, they'll get some value. It's a present value calculation, basically, Dustin. It's not good if they put in, say, $10,000 and canceled it 3 or 4 years later, they wouldn't get back nearly $10,000. It would be 8 or something like that. You've seen these commercials on TV. The one I can think of, I don't know why it sticks with me, is J.G. Wentworth will commute some of the values and buy annuities from some people. That's what that's all about. Okay, but there's really no tabular cash value like you would have in a deferred annuity. Okay. Now, before we go to the next idea, I want to ask a question just by a show of hands. Let me see if I can figure out how to see more people. But I want to see how many of you, because the insurance industry has done a good job of convincing us that modified endowment contracts or MECs are evil. How many out there, by a show of hands, believe that MECs are evil? Okay. Well, let's go back first and be sure. Let me give a refresher course on what a modified endowment contract is. And this goes back 40 years ago when people were taking advantage of the tax-deferred growth of life insurance contracts and basically putting in large sums of money into the contracts and having the death benefit being a very minimal amount. So Congress tried to come in and change that. And first they did it with the guideline premiums, and that didn't work because the company actuaries, the product actuaries were smart, and they got around those rules by changing some formulas and doing some things. So then they said, we're going to limit how much premium you can put into this contract in the first 7 years. Now, it's a cumulative amount. So if you don't put all the money in year one, you don't lose it. It rolls in and you can put it in year 2 or year 3 or later. But if you exceed that amount, it becomes a modified endowment contract. And modified endowment contracts are taxed a little bit differently than just your run-of-the-mill life insurance contracts. Under both scenarios, the death benefit is income tax-free to the beneficiary. I say that in most circumstances, not all, most circumstances. With the non-MEC contracts, basically the law is you can remove your basis or the amount of premiums you paid first before you start receiving interest income on anything over and above how much you paid in the contract. Well, the modified endowment contracts changed that and said interest comes out first before the premiums. And on top of that, if you get that money prior to age 59 and a half, there is a 10% penalty on top of that. Okay. Now I'm going to stop right there. And that 10% premature withdrawal penalty is kind of, if you think about it, that's what that 59 and a half and the 10% penalty, that happens with annuities. It happens with 401ks, IRAs, everything. So that's kind of a basic for the IRS. If you get money before 59 and a half on these type contracts, you're going to pay the tax and a 10% penalty. There are some exceptions, but that's the basic rule. So the insurance industry was trying to protect this tax-deferred growth of the cash values of life insurance contracts, and they convinced all of us that MECs were bad. Well, I'm going to challenge you on that theory, and I'm going to do two things. We got two ideas here. The first one is if a corporation owns the policy, guess what? There is no 10% premature withdrawal penalty. That is probably not very well known because we just don't talk about MECs. We try to avoid them, so we don't ever really worry about what the taxation of MECs are and when that 10% penalty applies. So for corporations, it doesn't apply. That's kind of an interesting thought. Sounds like now we're getting more in the lines of even better taxation than annuities. So how can we put this into practice knowing that we can put $100,000 into a life insurance contract and not have a large death benefit? Well, there are a lot of companies out there that require strong balance sheets. And if any of you on the call are associated with surety bonding, have a surety bond department, you know that contractors keep large cash balances on their books for those surety bonds. Auto dealers, car dealers also have a large line of credit with the banks, and to make them look better on the balance sheet, they carry large balances on the books. So if we look at the life insurance as a place to stick that money, and I just did one for, let's see, it's $100,000 of coverage, $100,000 of one-time premium into an IUL. This is Nationwide's product. As you can see, this is at a current rate of 6.45% interest. Nationwide's cap is currently 10.25. They have a rider where that $100,000 is guaranteed to XYZ Corporation in the event of cancellation. And in 5 years, that $100,000 has grown to $113,000. Because a lot of this money is sitting in money markets at the banks, earning 1 or 2% interest, because the corporation doesn't want to tie that money up. Well, this asset's going to go on the books for the full $100,000 because That's what the surrender value is. But they have the opportunity to earn S&P 500 returns. Okay. So one of the reasons that people don't do this is they said, oh, the cost of a life insurance policy is so expensive to do this. Well, it is if you make it a non-met contract, because the non-met death benefit on this particular case was 5 times the $200,000, which means the expenses would have been what? Basically 5 times what it is on this contract. So I'll go down and show you how much they're spending to do this. Where'd it go? Oh, there it is. So they do have a premium charge of 8%, which is how we're going to get paid. This is one of these ideas. This puts money in the bank. Okay. But if you look at the other expenses in the later years, it's $2,000. It's 2%. And I would suggest that the caps on individual life insurance policies are higher than the caps on fixed indexed annuities. If anybody's using fixed indexed annuities for this same type of concept. So even though the cost of life insurance may be 1 or 2% more, the cap's going to be 1 or 2% more, 3% more maybe, because the caps on FIAs today are probably 8-9%. Okay, but however, the corporation's got a death benefit of $200,000. Now I'm going to throw a little bit of a curveball to you. If that corporation has key people that they insure with a term policy, and they've got cash they've got to keep on the books, why wouldn't they use this in lieu of those term policies on the key people? Because they're paying this insurance cost already, or more of it, right, on term insurance. But now they got a potential for S&P type gains. So to challenge you, met contracts are not always bad. Because I listen to the talk shows and the gurus, and they always say, oh, this is a bad idea, that's a bad idea. But they generalize. And I'm always of the belief nothing is 100% bad and nothing is 100% good. There's always some percent, I don't know, whether it's 2%, 5%, 10%, whatever that number is, there are applications for everything. And to me, this is a better application than trying to sell permanent key man type coverage to corporations. Plus, it solves the problem if they've got assets or cash sitting in the bank that's a quote unquote dead asset earning 1 or 2%. Why not talk to them about this? And I'll talk to somebody that did this. And he wrote about $7 million of premium in a year doing this. And I asked him, what's the hurdle? Why don't people do this? He said the biggest problem that you have is being able to sit down from that business owner across the table, look him in the eye, or him or her in the eye, and say, you need to put $1 million into this and ask for the check. He said that's the biggest problem. And that's what I see when other people, they don't have the ability to ask for that $1 million check. So for those of you that are in a PNC agency and have a surety bond department, you know what companies have cash on the books because you probably have a balance sheet on them. Those are your prospects. That's about it. Other than going out and selling it for you, that's about as much as I can lead you to the water. Now, if you find somebody and you want me to get on the call and explain the concept to them, I'll be happy to join the call with you. Okay. I'm just saying this to me is a great use of a MEC contract. Okay. Because if they put it into an annuity, for example, an annuity is taxable at death. Even though this is a MEC contract, the death benefits down the road are income tax free to the beneficiaries. Okay. So there's a lot of good. And if somebody's unfortunate to pass away in 3 or 4 years, guess what? There's a death benefit. It's going to be higher than what the accumulation value would be. Okay. I don't know if I did the ROI on this, but the ROI will at some point over time approach the crediting rate. Okay. So if the crediting rate is 6.45, the rate of return on the cash value will approach 6.45. Probably won't get there, but it will approach it. And if corporations see they're going to earn 6% on their money over time, it's probably a pretty good deal for them. So let me stop right here. Do I have any questions about this? Chris, you have anybody showing their hand? They have a question?
Ralph, I have a question.
Sure.
You had mentioned that the interest came out, or the interest came out. Could you go back over that part again?
The interest, when they take interest or any value out of the contract. So in this particular situation, the cash value in 10 years had grown to $141,000, and they wanted to take $20,000 of cash out of the contract, that would be taxable income to the corporation. Okay. It is not principal first, it is interest first, but no 10% penalty.
Okay, good.
Is that news to anybody that the corporations don't pay the 10% penalty on a corporate owned contract?
I forgot that
Yes.
Hey, I tell you what, I thought that was the case. I spent about 30 minutes last night on the internet trying to confirm that. It is a pretty well kept secret, in my opinion. I actually went and read the tax law, and the tax code says the taxpayer pays this penalty up to age 59 and a half. Well, the age 59 and a half means nothing to a corporation, but I could not definitively pinpoint that. So I called some advanced sales departments of 2 or 3 different insurance companies today to confirm that there is no penalty paid by the corporation. Okay. Now, by the way, when we get through this, if y'all would drop me a note saying, I like that idea, I don't like it, it's the worst idea I've ever heard, please do that. I'd just like to hear some comments on this or the previous one. Now, I told you I had 3. So the third one also takes into account this idea of using a MEC contract. And I think it's pertinent right now because we're in the season where some of the 401k plans are having their testing done for non-discrimination. And some of your executives will be getting refunds out of their 401k because they have contributed too much money. Has anybody seen that?
Not yet.
It's the same type concept that you can put that money, take that refund. They want to do something with it, put it into a MEC contract on an IUL basis and drive the death benefit down as far as possible. Because if you do that, that means it's going to have a 10% premature withdrawal penalty before 59 and a half. It's going to be tax deferred growth. And then when they start taking the money out, it's taxable income. That kind of sounds like a 401k taxation scenario to me. So you're able to do that by using, it's basically the same as they're seeing now in their 401k. It is after tax money, but still the taxation going forward is the same. And then somewhere down the road, the death benefit might be income tax free, or if they do start taking money out, at some point at the end, the basis would be returned income tax free. Okay. if you have this also, I'm surprised we don't see more of this, but you have people out there that are sole proprietors and they talk about wanting to do a retirement plan. And how much the administration costs on a 401k plan? Can we all say it's going to start at least $1,000 or $1,500 a year for administrative costs on a 401k plan? Why don't you put them in a life insurance contract that's a MEC? You got the same taxation pretty much. Got that tax deferred growth. You don't get the tax deduction, but you're deferring the growth of the assets. Just an idea. And I would assume the cost of a life insurance contract is going to be less than the administrative cost for a 401k for one employer groups or two employee groups. Again, just an idea. So to go back, we had 3 ideas today that we wanted to talk about. I want to recap those. The first one was the grandchild idea. Okay. Again, it's from what I saw and the expression on the grandfather's face when I was talking to him this week, this to me is going to be like shooting fish in a bucket. You ask a grandparent, you like that?
Yeah, well, I'm from Georgia, so it's just good to hear you.
I see you got a little gray hair too, so we were dating ourselves. But anyway, that to me, I'm sure you'll get some no's, but I think you'll get a lot more yeses than you'll get no's. So again, this is one that puts bread on the table.
That's a great
idea. One grandparent a month,
yeah,
3 or 4 grandkids. You're going to make $600 to $1,000 a month or more, just additional by asking the question. The second one is the idea of the MEC life insurance for those that carry assets, large assets on their balance sheet. To give you a place to look, again, talk to your surety bond department. Contractors and auto dealers are 2 big ones, okay? And just have the courage to ask them for a big number, okay? And then the third one is for the top executives of companies like fast food restaurants, again, contractors, somebody that has a high turnover of their rank and file employees are probably having trouble with non-discrimination testing in their 401k. Just a guess. And take that money and put it in a life insurance contract. I prefer the non-MEC contract for that. But again, the expenses for the death benefit on a non-MEC are much higher than the expenses on a MEC contract. I did one. Let me see if I can't remember if I saved it or not. I did. Hold on. Yeah, I saved it. As I said, this is one for a 45-year-old, I think it was. Yep, 45-year-old. I did a $25,000 death benefit and put $5,000 of premium in it. And down here, I got a internal rate of return. As you can see, the return of the surrender value, it's 75 is 6.22%. It's increasing up to what the crediting rate is on the illustration. Will that appeal to every 45-year-old? No. Will it appeal to some? Yes. Okay. And again, it's not meant for this is more like their cash accumulation, cash part of their assets, not their growth funds. But again, you got the S&P 500, you get the gains on the upside up to the cap with 0 downside on the return. The old story is 0 is my hero. Okay. So if you got anybody in annuities, look at them too. I think they'd be better off in a MEC life insurance contract. So those are my comments for the day. Again, if you'd like to drop me a comment, send it to rmoore@brokerhouseins.com. Just tell me, said, that's a great idea. That's the worst idea I ever heard. Or, yeah, I think I can use that. So if you would, just let me know. If you have any questions, you can drop me the email also or call me. My cell phone is 205 821 8202. 205 821 8202. If does anybody have any questions that they'd like to cover before we go? All right, we'll go out and shoot some fish in the barrel then.
Thank
All
you.
right. Thanks for your time. All right. Bye-bye.
Bye-bye.